The biggest disadvantage of investing your money in real estate as an asset class was one, you needed a lot of money before you could make your first real estate purchase. And second, if you ever wanted to sell that and liquidate your money, you would have to wait for weeks together before the money is in your bank account. Searching for a solution to these two problems gave result to the birth of what are known today as REITs, that is, Real Estate Investment Trusts. In simple terms, a REIT is like a mutual fund which invests your money into real estate properties. So how does this work? As an investor, you purchase units of a REIT, and the REIT, which has collected money from a number of investors, uses that money to buy real estate properties or to give loans to real estate developers to help them complete the projects that are under construction. The REIT earns money in the form of rental income on the properties that it has invested, in the form of appreciation in the price of the properties that it has invested, and finally in the form of interest income on the loans that it has given out to the real estate developers. All of this income flows to the REIT, and the REIT in turn passes it on to you as an investor, either in the form of the dividend that it declares or in the form of appreciation in the price of the units that you own in a particular REIT. What the REITs have done is they have democratized the ownership of real estate. Why? Since the minimum investment in a REIT is only INR 50,000, it allows you to buy REITs at a much smaller minimum investment compared to the lakhs that you'll have to put aside for a physical real estate property. And since the units of the REIT are listed on a stock exchange, that gives you liquidity in terms of allowing you to sell the REITs on the stock exchange at the prevailing price. What you should understand is when you own a REIT, you do not own any real estate. You own units of the REIT, which in turn owns the physical real estate properties. And since the REITs earn the major chunk of their income in terms of rental received from these properties, the REITs in turn distribute 90% of their income in the form of dividend to all their investors. While you have a number of benefits of investing in a REIT versus a physical real estate, what continues to be the common underlying is that you are still exposed to the risks associated with fluctuation in the prices of a real estate property, or the risks that a real estate property has. Those risks you continue to bear them as you own these properties through these REITs. So these are high risk, high return investments, but with the addition that they are liquid in nature, so that one small risk is taken away, and second, they allow you to invest in small amounts and start taking exposure at a much earlier stage than waiting to accumulate lakhs of rupees. To understand this better, let's look at the Embassy Office Park REIT, India's first REIT, which was launched in the month of March 2019. This REIT was launched at an IPO price of INR 300 and collected INR 4,500 crores from its investors to make its initial investments. The REIT owns and operates about 33 million square feet of commercial property across Bangalore, Pune, Mumbai, and Noida. In terms of the investment the REIT has made, 92% of the REIT is invested in commercial offices which are let out to companies in the technology sector, in the healthcare sector, telecom, and financial services sector. The fact that the Embassy Office Parks REIT was launched in March 2019, REITs as an investment structure are pretty new in India, and if you look at the kind of returns the Embassy Office Parks REIT has given from March 2019 to March 2020, it is pretty interesting. The REIT listed at a price of 300 and it has seen fluctuation from 300 up to 500 plus and back to the 350 levels towards the end of March 2020. In terms of the dividend distributed by the REIT, it has distributed an amount of INR 24 rupees in the year, and that translates into a dividend yield of 8.1% had you purchased the REIT on 1st April 2019 when it was trading at a price of 313. So if you look at the total returns you make on the REIT in the financial year 1920, you would have purchased it at 313 at the beginning of the year and the closing price of the REIT was 350, giving you a price appreciation returns of 11.82%. the dividend yield for you would work out to 8.1%, which is nothing but the sum of the dividend received in each of those 4 quarters divided by your purchase price of 313. That gives you a total return of 19.92%. So you can see this REIT has actually given returns which compete with the returns equities give you. And that's not without saying that the REIT comes with a high risk, high return profile attached to it, which can be seen in the fluctuation in the prices of REIT, which has moved from 300 all the way to 500 plus and down to 350, all in a span of 1 year. Having said that, the REIT is an option which you can consider if you have a high risk taking capacity and you would like to diversify your portfolio. If you do not have any exposure to real estate and you would like to start taking some exposure, the REIT is a very good place to start doing this. In addition to that, if you have a portfolio where there is a constant need of income, if you're dependent on the income from the portfolio to manage your regular expenses, then the REIT is a very good option because they distribute more than 90% of the income that they receive on a quarterly basis, and that can add to the cash flows that you need to manage your regular expenses. If you look at how you would be taxed if you were to own a REIT, you have 2 kinds of income. One is dividend income and second is your capital gains, which again are segregated between short term and long term. The dividend income would get taxed in your hands, would get added to your income and would get taxed as per the slab rate that you belong to if the REIT has opted for concessional rate of taxation. If the REIT does not have a concessional rate of taxation, then the dividend income is tax-free in your hands. With respect to capital gains, if you've held the REIT for less than 36 months, it qualifies as a short-term capital gain and is taxed at a rate of 15%. Whereas if the REIT is held for a period of more than 36 months, then it is taxed at a rate of 10% as long-term capital gains. And just like equities, you enjoy an exemption of 1 lakh rupees in terms of capital gains, which are not taxed on a financial year to financial year basis. If you look to the developed nations, REITs is a pretty popular form of investment for anyone looking to take exposure to the real estate sector. In India, it is a relatively new form with a history of less than 18 months to show and just 2 REITs to look at. But having said that, the kind of performance they've given, not just in the price appreciation, more importantly in terms of the yield that they're able to give you, it is a very interesting option that you must consider when you are building your portfolio. To sum up our discussion on REITs is a very interesting way to start owning real estate with smaller amounts of money, and they come with the liquidity associated with equity shares as the units of REITs are listed on the stock exchange and can be sold easily. While REITs come with the advantage of being more liquid than physical real estate, they still are exposed to the risks of investing in real estate, which can be seen in the fluctuation of the price of the Office Embassy REIT in a single financial year. Finally, REITs can be considered as a good investment option if you're looking for constant cash flows from your investment portfolio, especially if you're retired and you're dependent on your portfolio to take care of your regular cash flows. This is an option which you can consider. With this, we'll wrap up the discussion on REITs, and the next session is going to be on how you can start investing in a mutual fund.